Your savings bank account is like a leaky bucket. As much water as you're putting in, there's always a bit of a leak. I'll explain why that is and what you can do to find alternatives. First, the reason we're talking about this is because State Bank of India announced that it was cutting its savings bank account interest rate to 2.5% from 2.7%. This is after the most recent cut by the Reserve Bank of India of 50 basis points. Now, State Bank of India has done this, but a lot of other banks like HDFC Bank, ICICI Bank, especially the larger banks, are likely to follow suit. What does that mean for you? Let's talk about it in terms of an example. Let's assume that you have a minimum balance that you keep of 1 lakh rupees. And I say minimum balance just for the purposes of this explanation. If you calculate 2.5% on that, you would effectively be getting about 2,500 rupees of interest over the course of a year. Now remember that you earn this interest on a daily basis. It gets paid to you on a monthly or a quarterly basis depending on what the bank that you bank with follows. You're earning about 1,750 rupees post-tax if you are in the highest tax bracket at 30%. But what happens when you account for inflation? And here we're talking about 4% inflation, which would have an impact of 4,000 rupees. What this means is that 1 year down the line, with that 1 lakh rupees, you will be able to buy 4,000 less than what you can buy right now. And so if you account for that, the value of that 1 lakh rupees, along with the interest that you've earned after 1 year, is only about 97,750 rupees. So in essence, you've actually lost money by keeping it in your savings bank account. What is the alternative? There are a few for you to consider. Each of them has pros and cons. Let's go through them. The first one is a flexi fixed deposit, also known as a sweep-in facility. This is where beyond a certain threshold, and for some banks this is 35,000 rupees, for other banks it is different, anything that you contribute over that. So suppose you've got 35,000 rupees in your account and you get your salary, whatever comes in above that gets pushed into a flexi fixed deposit or fixed deposit in certain multiples. That could be 5,000 rupees, that could be 10,000 rupees. Each one of them forms fixed deposits. What happens here is that you get a rate of interest that is much higher than your savings bank account on those deposits, and that is certainly a positive, but any interest that you earn is still taxable at the slab rate, and what is more, you will use this account to transact, and it gets pulled from the top. So imagine that fixed deposits constantly getting diminished, and you don't get the full value of what you see on the tagline. What else can you consider? Let's run through the list. You've got short-term debt funds. These are mutual funds that invest in, and there are several of them, liquid, overnight, ultra short duration, low duration. What do? They invest in money market instruments, etc., that give you a rate of interest that is significantly better than your savings rate. And there's also a deferment of tax. So you only pay tax when you pull money out of that liquid fund or overnight fund as you invest in it. What is the problem? It is liquid, but it is not as accessible as a savings bank account. So, for example, if you redeem, the money is available to you on the next day. And it is also taxed at slab rate, but you can defer that tax. Remember, what does it invest in? Treasury bills from the government, including from the state governments. It can also invest in certificates of deposit as well as commercial papers that are issued by banks and companies respectively. There is arbitrage funds, which is next, and this is something that has become very popular because this still attracts an equity taxation. Basically, it is playing off the difference between the cash market and the derivatives market in the equity space, and it gives you a certain spread over that. You earn a little more than you would earn in a liquid fund, but the risk is slightly higher. Let's talk about the pros and cons. The advantage is that you earn better returns than a liquid fund, but it could be higher risk. You have to be willing to hold for slightly longer periods of time of at least 6 months or thereabouts. The problem again here is that it's liquid, but it's not as accessible as a savings rate. And the last one is actually a new entrant. It's an income plus arbitrage fund. It actually combines the liquid fund that we were speaking about and also the arbitrage fund. Now here too, the issue is about liquidity. You get better rate of interest, and this is long-term capital gains at 12.5% after 2 years, but it could cost more because of the fund of funds structure. Now finally, to sum things up, there are several options available to you that earn better than a savings account, but there's nothing that is as liquid, perhaps cash, but you don't want to keep too much cash either. So what you need to bear in mind is that you need to adjust how much you would require in the state of an emergency and what can be accessed by other members of your family, and the rest can be pushed into an arbitrage fund or a liquid fund or even an income plus arbitrage fund, depending on what you prefer. Bear in mind that penny pinching is not the idea here. You should have accessible funds, and the savings bank undoubtedly is the best for that, but you should be earning more than 2.5%. And that brings us to the end of this edition of Your Money Matters. It's been an absolute pleasure bringing it to you. Let us know in the comment section what you think, and do stay tuned. This is NDTV Profit.